Increasingly, as most folks listen to Tabb Forum, know we are in a high-frequency trading world, especially when it comes to provisioning liquidity in major markets like the U.S. and European equity markets. Increasingly, liquidity is provisioned in milliseconds, microseconds, and now I think I caught a release today that somebody's quoting in nanoseconds. How do you respond to that? That's a different story. But I'm sitting here with Keith Ross. Keith is the CEO of PDQ Enterprises, and PDQ is looking at this a little bit different way. He's looking at trying to actually bring some of the fixed income RFQ, request for quote, request for markets methodology into actually the equities market. So welcome to Tabb Forum, Keith.
Thank you, Larry. It's a pleasure to be here.
Great. So why don't we talk a couple of seconds about PDQ and what kind of market and how kind of it works.
Well, PDQ is in the current electronic space, a unique market structure. And our clients that are looking for liquidity agree in advance that we can pause their order for up to 20 milliseconds.
20 whole milliseconds. Are you sure they can wait that long?
20 milliseconds is a long time these days.
Mm-hmm.
When we started, it was a shorter time. We also have a 5 millisecond option for the speed guys.
Okay.
But the process creates a different type of market structure that allows us to really do some very nice things for the orders when we have them. So an order comes to PDQ, we pause it, and then in a very secure fashion, we can request markets from our market makers and high frequency traders. Mm-hmm. So these are the usual people that make markets. Similar to the bond RFQ that you mentioned, we actually send out what we call a request for trade. Mm-hmm. An RFQ, as the street knows, is an indication of what you think you would do.
Right.
It's not a commitment.
It's not formal, right? Mm-hmm.
But our RFT is actually a live market that they send back to us.
Okay.
So an order comes in to buy some Microsoft. We may send them just the symbol that says, "Where are you in Microsoft?" They respond with a two-sided market. We are bound by the national best bid and offer, so we're not straying away from where the marketplace is.
You're NMS compliant.
We're NMS compliant, and then we will match the trade with the best response.
So why does that benefit me? So if I have the traditional HFT guys, and they're displaying a market of 100 or 200 or 500 shares, but nothing really significant. Why would I come to PDQ just to get them to respond with 100 shares, and
there instead of at BATS or
instead
ARCA.
of BATS, ARCA, or NASDAQ, whatever. Mm-hmm.
So what the pause does is it allows us to aggregate the high frequency guys. They also need to compete with each other because they're allowed to price improve, so that now instead of when you trade with one, all the rest of them run away, they're responding to your order and they're competing to fill your order. And if you have a big order, you may get to trade with all of them at the same time.
Also, can in effect sweep all that liquidity that comes in?
Yes.
Okay.
If the client order is large enough, it would trade with all the responses that we get. Mm-hmm. And I come from the high frequency world in my previous career. The advantage for the high frequency folks is they are now responding to an order. They don't have open inventory risk in the marketplace. And there will be conditions when their algorithms realize this is the time to make a really big trade because everything lines up. So if you're doing a pairs trade or a hedge trade or possibly a basket, in that 20 milliseconds, your algorithm may realize that this is a really good time for you to make a bigger market.
Or I'm laying off risks that I've accumulated from other places.
Absolutely, absolutely.
And so in this 20 millisecond market, or for the speedy guys, 5 milliseconds,
right?
It really turns the market on its head. It really takes the risk away from the quoter and enables the quoter to really respond with whatever they can fill at that point in time, instead of really having the risk of, I don't really know what you're going to do, and I just need to really limit my risk about what I expose myself to.
The efficiency for the process comes from a much better risk profile for the provider. And it's not that they're always going to be able to make a better market or a bigger market. There will be circumstances they don't want to make any market, but that's normal anyway. But in those circumstances where they can, It's a safe way for them to provide size to the marketplace, and an institution or a large trader can get a fill at one price or two prices.
Now, we had a conversation a little before this. Also, there's an interesting tiering of liquidity or tiering of fees, within the market as well. So you're saying, well, sometimes it's retail liquidity that you're paying, that in effect it's like that you're paying for. So in effect, when you trade, me as a liquidity provider, when I trade against this retail flow, I'm actually paying for the privilege of trading against that flow. And then other times it's the opposite. So why don't you talk a little bit about that and how that works?
Since we're not an exchange, we're only an ATS, we can actually custom price all of our flow. So when we're working with a client that's looking for liquidity, they'll tell us how much they're willing to pay, or if we're out working with retail firms, they get paid for their flow. We turn around, and in each and every order, we have the associated fee or rebate that we will communicate to the market makers and high-frequency trade liquidity providers, so they can include that in their analysis of the bid and how they want to respond.
So interesting. So to a certain extent, if I'm receiving an order, it tends to be a retail order. I'm not going to get a credit for this. I'm actually going to pay to interact with it. On the other hand, if it's an institutional order, I might actually get a credit for interacting with this flow. So on each transaction, not only am I looking at what is the symbol, what's the liquidity, where do I want to be a more aggressive bid or more aggressive offer. I also need to think about where does the fee structure run into this? Am I going to get paid? Am I going to pay? How does that? That's very interesting.
I mean, one of the things.
It's tremendous transparency in terms of how do I interact with this.
I mean, one of the things I believe about our electronic marketplace is that it's so efficient that the high-frequency traders, the rebate or cost of a trade is very significant, and their profit is a fraction of the rebate. So some people talk about that as an additional fee in terms of making a wider bid-ask spread because of the take fee on each side. But I think a better way to view that is if you believe that they're willing to make essentially a pick-em price, a flat price at 10.00, rebate on each side, you now almost have infinite liquidity because they're willing to trade at the same price if they can earn the rebate.
Interesting. So you really have basically a two-sided market at the same price.
Right. So the buyer or seller can pick which way they want to go.
Interesting. So right now, you're not really marketing out to the investor community. You're really kind of mostly focused at the retail side and kind of the agency market maker side.
We have a lot of day trading groups.
So how do you see that changing, and kind of what's your composition of flow?
Well, we're as I mentioned earlier, we see about 275 million shares a day come through our system. So our numbers are growing nicely. We executed 37 million yesterday, and we're running a little better than 0.5% market share, which isn't monumental, but for a young company, we're pretty proud of that.
That's great.
And our next mission is I think we need to educate the buy side about how we interact differently with the high frequency guys, how we can, in a sense, sequester them so that they can't do all the nefarious things that appears they can do in the electronic marketplace. And also give the high frequency community an opportunity to respond to institutional size orders and provide that liquidity. And we're seeing them respond even at our current metrics with over 500 million shares a day of available liquidity.
So these guys are stepping up to 500 million shares? That's interesting. That's really interesting. So I think at that kind of level, it starts to get interesting for the bigger guys.
We hope so, and we'll be hopefully talking to them soon.
Well, with that, I think we'll call it a session. Thanks, Keith, for joining us. Interesting idea. How do we slow the market down to really get a better understanding of risk and liquidity? So with that, I'm Larry Tabb, founder and CEO of Tabb Group. Thanks for joining.